Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan talks with Michael Guyette, publisher of the Lead Lag Report.
For today's rant, we just can't resist talking about SBF, the CPI, and Greg Diamond's weird cycle chart.
And remember, you can email us at feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Well, he's back. I mean, I don't want to talk about Sam Bankman-Fried all the time, but he keeps coming back. Like, he must be the worst client for an attorney in the world because he will not shut his mouth. And now he's taken to Substack. Like, he's been arrested. He's been charged. And he's taken to Substack to keep babbling about, his excuses and what went on. I can't believe it, this guy.
Yeah, it keeps surprising us. Like, maybe he shouldn't at this point, but it was... when I saw those couple headlines this week, he did an interview from under house arrest, which is always nice. And then he started his own Substack newsletter. So it's, I had the same thought. He's back. It's like he's at this point, he seems like a fallen celebrity who is just trying to hang on to some shred of popularity at this point, to me, more than anything.
Yes.
Yeah,
absolutely. He's and the tone of the thing, it comes off that way too. It's like there's this underlying implication all along when he says, for example, like, the same thing that crashed our assets 80 or 90% or whatever it was, crashed everybody else's too. So, as if to say that wasn't particular to us. So not my fault. Just like,
yeah, but it was particular. It was very particular to them. There's a lot of things that have been down 80, 90% this year and haven't, bankrupted an entire business and screwed over their customers. So it is very particular.
And been charged with fraud.
Yeah, and been charged in the Bahamas, where you'd think he'd be freer to get away with such matters. Right. It's hard to do, to get arrested in the Bahamas. Yeah,
that's right. The Bahamas, like, even we're not this laid back. You're under arrest.
We don't want you. We don't even want you here.
Yeah. And they found money. They found, like, from what I was reading in the Wall Street Journal, a total of $9.6 billion, like $5 billion in really decent liquid assets, and then another $4.6 billion of book value of God knows what, probably stakes in crypto companies or something. I don't know.
Yeah, I saw a couple of things like that too, which reminded me, like, at the very beginning of all this, we were maybe trying to give, or I was trying to give him a little benefit of the doubt, like, hey, we don't know everything that's going on here. But now I saw something like how much money they spent on food and like all these other things. It's just stinks. The whole thing smells, and I'm glad he's behind bars or on house arrest at least. And I honestly, I like Jerome Powell. I kind of forgot about him, to be honest, until I saw it this week, and just that's the way my mind was working. But I'm glad he's getting prosecuted at the very least.
I agree. The Fed and Sam Bankman-Fried. It's like, I'm so sorry I have to talk about this, but I can't resist it. That's the kind of topic it is. It just won't go away. It's in your face all the time. Ugh.
Yeah, and we shouldn't forget about it, because these are the things that people will forget about them, and then these sorts of things will happen again. So
right.
It's just kind of human nature. But
that's my story too, and I'm sticking to it.
Yeah, there we go.
It's just so much fun. The truth is, it's so much fun to talk about Bankman-Fried and Cathie Wood and even poor Michael Saylor and all of these other folks who just rode the bubble so hard and look so ridiculous now that it has begun to burn. Now that the really crazy speculative parts of it have just completely deflated and fallen apart.
But it is a bit entertaining mostly as well. Yes,
I should say mostly fallen apart. I mean, Bed Bath and Beyond was up, 200 or 300% last week, so mostly fallen apart.
Yeah, there's still some bubbling going on, I would say.
Yeah, those people still have money left, and they're doing what they've done for the last several years. Of course, the other thing that we can't, it's something that actually is in our face all the time that we should talk about maybe is inflation. Of course, the latest CPI came in at 6.5%. The what was it? I can't keep track anymore. Sixth consecutive drop in year-over-year increases.
Yeah, it was since June. So whatever
Okay,
the math is
whatever
there.
that is.
Yeah.
Yeah.
It was over 9% in June, down to, this is the annual number, and then down to 6.5 for December. But I think the more useful thing to look at there with the CPI number is that month over month comparison.
Mm-hmm.
And that was down 0.1% from the previous month, which might not sound like a lot to most regular people, but relatively speaking, it's important, just showing that the pace of inflation is slowing. And if you go deeper into the data, some areas are showing deflation already. So certain parts of the data. So that's significant too. But we'll see where that goes. The market really didn't do much in reaction to it. I think this sort of thing's kind of been expected largely. But I have a couple thoughts on it to watch going forward, but for now it's just kind of more of the same. It's like you said, it's 6 or 7 straight months of slowing inflation, but inflation is still there, is the main point, is my main idea.
Yeah, I mean, we're fairly obsessed as a society and, as a market, I guess you could say, with year-over-year increases. But if you just look at the CPI index itself, it's up and to the right forever. I mean, it almost never goes down. And another way of saying, that the increases are slowing is to say it went up again, and it just goes up and up and up forever.
Right.
Yeah.
It's rising slower. Yes. Rising. Yes.
Yeah. And the idea that this is bullish for stocks is comical, because in the last mega bubble, at least for valuations, the 2000 peak, CPI, I think it started out, let me take a look here. Yeah, it started out around 3.8% at the peak in March of 2000 and wound up at around 1%, but near the bottom, in 2002. So falling CPI after an enormous mega bubble, not particularly bullish necessarily. Maybe it's good for consumers, right? You're not paying as much more for stuff, but the idea that the market ought to rally on this kind of stuff is a little serious.
Yeah, I think especially if we're maybe getting into the deflation part of things too, in certain parts, that's not good for businesses either. I mean, especially if when you look into this, like the data a little bit more, it was mostly gas price driven. This, and how much lower a gas price is going to go from here? Probably, I can't imagine very much. What, are they going to go down another $1 per gallon? Or I don't think so. And the housing and rental cost part of it, is that going to go down? No, I don't think any significantly. There's still, like we said, that fundamental shortage of housing. I don't think businesses are going to start lowering prices, but they're still going to try to be making money, which for the regular consumer doesn't turn out well, because a lot of the wage part of this is sticky. Is still. Mm-hmm. I wrote about this a little bit this week. Basically, even if inflation comes down throughout the rest of the year, and the Fed's weighing with their policy is weighing this stable prices and maximum employment. So, and there's 10 million job vacancies at this point. So assuming job losses don't pile up, but some of those vacancies come down, we're still at record unemployment right now. So the job market's going to be still tight, as they say, and skewed in workers' favor. And that means the wage and salary inflation is still going to go on. And now that's not bad for regular people who will make more in their paycheck, but for businesses, that's more costs for them. And then they're going to raise their prices on the back end to those same people, and on it goes. So it's just, this is why inflation just stinks. is what I said,
Yeah,
and it's insidious,
yeah, and it's up and to the right forever,
Yeah.
pretty much. And not only that, but if your obsession is the stock market in all of this, and you're maybe thinking, well, lower CPI, more chance of a Fed pivot and all that stuff. Well, not only are they not talking about doing something like that, but it's not, that wouldn't be bullish. Past pivots have not been bullish. So the whole idea that blessed relief, the CPI is coming down. No, I don't think so. I don't think we get out of the biggest financial mega bubble in all recorded history without substantial economic pain. I mean, it's always been that way. It was that way after the 29 bubble. It was that way after the the Japanese escapade, that bubble. It's just the way it goes. The excesses
what
have
is
to
it?
wash out.
The last 7 bear markets or something like that haven't ended until that pivot happens, and so there's a lot of
Right
things that can
after,
happen between now and that point. That means things have gotten to a point where the central banks have finally said, "Hey, we need to reverse course here and help, and loosen things up again." And so we're not at that point yet.
And what's more inflationary, hikes or cuts? I mean, we kind of got here with loose monetary policy, and I understand the dynamics. QE is not necessarily inflationary. I understand the market dynamics of it, but QE and then 10 trillion of stimulus or whatever the total was in the end. That obviously does cause a little bit of inflation for a while. So I don't know. I think it's like, it's Jim Grant said some time ago, years ago, it's like we're at a major league, sporting event, like a baseball game or something, and we're obsessed with the umpires, right? We're just talking about, we know the names of all the umpires. The umpires are on the cover of all the sports magazines, and that's all they talk about on ESPN is umpire, umpire, umpire. That's what all this obsession with the Fed is. But I think they have a lot less control over things than anybody believes.
Agreed. Yeah, and if I was at a baseball game, you don't want to see the umpires or the referees or the officials. They shouldn't be making any, drawing any attention to themselves. Should be the players, which is, the stocks, the businesses, and whatnot, and the people, like you say, right? Fish and water. I love that analogy. Actually, it's just, maybe I'll stop writing about the Fed now.
Yeah, that's right.
No umpires.
Forever.
Yeah.
No umpires. Yeah. All right. Well, we should talk also about Greg Diamond, who was on the show recently, and viewers apparently loved it. They tuned into his webinar and had some good things to say about that. But the most fascinating thing, though, and I'm always fascinated with such things, is this 7-year cycle that goes back to, like, when is it, like the Civil War or something? I don't know the exact date that it starts.
Post Civil War, 150 plus years ago. So it's, that during the event, Greg, who we talked to last week, he talked about a lot of things, but the one thing that made me chuckle was what you said. This brought up this chart from this old pig farmer from Ohio, who was a wealthy farmer, lost everything in a market panic and also a hog epidemic back in the 1800s. And he tried to make sense of it, what happened. And eventually, and I don't know the full details, but he settled what Greg shared, this chart of, like, basically panic and boom cycles that this guy settled upon. His name's Samuel Benner, through the year 2053. And when you look at it, I wish I could show it, but it's, it's got these different boom and bust cycles, the last one topping out in 2019, and going down to kind of a bust in 2023. So hello, that's pretty good. And the last one was a panic before that in 1999, and Greg called this a cash panic, basically, that everybody wanted to kind of were paying anything for .com stocks. So anyway, the point was, if nothing else, I would check out, if you haven't, check out Greg's presentation just for this chart alone. I would say is worth it, and just kind of peruse that for a bit. It just it speaks to the idea that we were talking about cycles and how they're maybe undervalued by a lot of people who have money in the markets.
Yeah, people misunderstand them, and they get too caught up in wherever we are currently. They're too short-term oriented, I guess is one way to say it. But I like the chart because, it's got a major bottom in 2023, and then it's got sort of an intermediate top in 2026 and another major bottom in 2032. That's kind of, I consider that like a sideways action, and that's kind of what I've been talking about for at least several months now. Talk about it mostly in the Ferris report and, the videos that we make about that. But it's fascinating because this guy did this thing in like 1920 something or whatever it was, and he took it out to 2053. I mean, that's the kind of confidence that you just don't see anymore. You just don't see this anymore, where people are, it's like the Japanese corporations and their 100-year and their 500-year plans.
Right.
I haven't heard a lot about that lately.
Yeah, who did what was it? 100-year bond a couple of years ago. I forgot which country did that. Yeah,
Argentina, maybe. Yeah,
that was it. Yeah, but yeah, similar thought there. Yeah, I think what's also interesting to me with the 2026 kind of intermediate little rally here, that also aligns with the cycle that I put a lot of value in, the kind of like the 80-year saculum cycle. That's when that's the year where Neil Howe would say that's supposed to be the year when like the great end of this crisis era ends, which would make sense. And it ends with kind of a war, total war, which the war we have going on now is the Russia-Ukraine war, and you would hope that it doesn't go for 3 more years, but it's certainly possible the way it's going, especially if it gets worse, and other countries get involved, and it just kind of spirals into some sort of mess and like another direct war between 2 or 3 other parties. I don't think I can't foresee Russia and Ukraine fighting for 4 more years, but who knows? I don't know.
Who knows? Yeah.
But anyway, the point was these cycles kind of, especially when with these different cycle theories line up with each other. I think it's worth looking at. So,
right. It gets interesting when that happens. I always have a voice in the back of my head saying, "Don't be fooled by randomness." But it's fun to think about it.
Yeah.
And certainly, like the generational theory, the Neil Howe's generational theory that you mentioned with the saculums and all that. It's interesting, and he cites, a fair amount of. I mean, by its nature, it's backward looking. So he just, he looks backward through all the American generations, back to the founding of the country, and it's kind of fun. And you see, oh wow, yeah, he's got these 4 archetypes, and I'll be darned if they don't reappear, according to the evidence that he presents.
Yeah.
If nothing else, it's a really good story, and it might be a really good insight about how human societies evolve over these 80-year periods and in these 20-year generations within them. It's, at the very least, it is like irresistible. It's like mind candy at the very least.
Yes. Yeah. I wouldn't necessarily be market timing to the year and the date based off of it, but I think it does inform like what is possible based on long-term cycles that most people living, frankly, now are not aware of, nor really should they be. But for people like us who look at these sorts of things, it's helpful to see patterns over time, and that's really what we're talking about. So.
Right, and for investors, I mean, the point about being cyclically aware, I would hope, is once again obvious, right? Because it's easy for a guy like me to rant and rave all through 2021 like I did, but then when the chickens actually come home to roost in 2022, then people are patting me on the back at conferences. But up until that point, they're saying, really? 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 It's just it's when the cycles turn, people go, oh, of course. But right up until that moment, they can't bring themselves to fully embrace it. It's just a insidious nature, part of human nature. Anyway,
Well said.
so be aware of cycles, I think, is the point we're trying to make, and there are many ways to do that.
And check out Greg's presentation if we're still using dan2023.com.
Yeah, so be aware of cycles and check out Greg's presentation at dan2023.com. Make up your own mind. But I think Corey and I are both sort of trying to promise you that once you get to this chart in the presentation, you'll really be tickled by it at the very least, if not fascinated. And Greg, of course, he actually has nailed, lots and lots of trades over the past year, in part by using this cyclical insight that he gained from this chart. So, real money is made off of this. We're not just sort of talking, casually about some. This is like real money, and Greg is the guy who sort of figured it out. So you can go to dan2023.com and check that out. Why don't we go ahead and talk with Michael Guyad now? I love Michael. I love his Twitter feed. It's definitely worth following. We'll talk about it during the interview here. A great guy, and has lots of insights about what he expects to happen this year, and a particular view on how he thinks about whether or not things are going to happen. I find his view very measured, very smart. Let's go ahead and talk with Michael Guyad. Let's do it right now. Many mainstream analysts are predicting that stocks will recover soon, but I say we'll instead witness a cash frenzy unlike anything we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. Now, I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation. As all this unfolds, the financial consequences could last for several decades if you don't understand what's happening. There will be winners and losers, and now is when you decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone.com for a free copy of this new report. And with that, Michael, welcome back to the show. Good to see you again.
I appreciate the invite as always.
Yeah, so I have to tell you, and this is for our listener too, following you on Twitter at Lead Lag Report has become more exciting than ever. I mean, you're one of the folks in my feed that I have got to sort of check in with every day. And I have to commend you too, Michael. You've developed like a real brand, I know I could know it was your feed even if it didn't have your name on it, And so let's talk about some of that. When you say, for example, the one word that I associate with you is few, and you say the word few a lot. And I know what it means, but why don't you give our listeners an explanation of why you use the word few so often?
You can say I use it many is, I think, the way to.
Yes.
I tell you, the social media world is fascinating in so many ways. The way that people get triggered. So around the top of the Bitcoin and cryptocurrency peak, if you remember on Twitter, everyone had laser eyes, right? It was everywhere. Celebrities, individuals. I mean, it was just every single place you could imagine. And I'm a student of market history. I mean, I'm one of those guys that when I was a kid, I was reading all kinds of books, on markets. And history would suggest that when you have that kind of conviction, that kind of popular narrative, that tends to be a top, at least for now. But it's more than just the idea of everybody having laser eyes back then. It was also that there was a certain degree of vitriolic response where it was the people who had the laser eyes and everybody else and everybody else didn't understand why these people had laser eyes. Now, the Bitcoin community has used that line, if you understand this, since I think 2017 or so.
Mm-hmm.
But in early 2021, I was basically just trying to have an out loud conversation on Twitter. I got attacked by a lot of these so-called Bitcoin maxis for narratives that I was picking apart back then, which now ended up being right in the way I picked them out. But as a way of sort of countering the vitriol and the idea that that only few understand this, I started using it as my own meme. It's sarcastically to kind of mock the idea that people think they know something that others don't. So I started saying, if you understand this, few. Then I threw in exquisite, atrocious, and it became a bit of a brand. And I instead of having laser eyes, I put lumber and gold eyes. I mean, it's funny because I was basically turning my Twitter account into a little bit of a parody of all the things that I thought were wrong about the cryptocurrency.
Exactly. That's why I love this, because their smugness was real, and yours is mock smugness when you say few. That's why it's brilliant.
Right. But then people think I'm being smug by saying few because they don't understand.
Exactly.
I can't win. So like, if you don't get the joke, you are the joke, right? That's kind of.
That's right.
So I keep on doing it, and that's why, because sometimes I have to explain the joke. Somebody's like, "Oh, will you stop with the few? It's so arrogant." It's like, you guys are not understanding it. First of all, when you've been in the business, and I'm somebody who's skin in the game. I run funds. We'll talk about that, I'm sure. But the market humbles everybody, but at different times. I've been humbled a lot in this business because the cycle didn't really favor the approach. I think maybe that's finally turning. We'll see. And last year was a real anomaly in that sense. But part of humility means knowing what pain is. And believe me, I know a lot of pain in the industry launching strategies at the wrong time. So, arrogance is what gets you in trouble. I often rant against overconfidence. And yet when people see few, they get so triggered by it. It's somewhat comical. And I debate every day. It's like, should I keep going with this? And then I say to myself, the fact that few really do understand this means I should keep saying few.
Yes. No, you should keep saying it. I just want you to know some of us continue to get it. All right. So I want to talk about specific tweets because that's my window into you. And so a couple of them recently, and by recently I mean around January the 11th or so. You're talking about seeing the potential for a rally, a little melt up here, little or big, I don't know, melt up. But you're simultaneously talking about the potential for what you call a credit event in 2023. So most folks, they're sort of they're monolithic. They're just like one size fit, one-sided views, right? So it's either up or it's down or it's bullish or it's bearish. This is clearly sort of both at once. And you use another word that you just throw out, that one word, path, when you talk about these things. So tell me about this. Tell me about potential for a melt up, simultaneously potential for a credit event, and this word path.
So first of all, you and I both know that you can be both bullish and bearish at the same time.
Oh yeah,
right. It's just a function of time frame, which is amazing how people don't really understand that concept to begin with. Right? It's like you can be bearish on the entire world, but how you get to the lower lows is ultimately what matters. The sequence of returns, the path. I always go back to that point. Path matters more than prediction. So it's interesting, right? Because on FinTwit, everybody likes to talk macro. Everybody likes to talk about all these things, which are really ultimately all about endpoint. But the only thing that matters for traders, and I'd even argue investors, is because they react off of path, is the path, the way that you get to the endpoint, the dance in between the raindrops, so to speak. So let's take a step back. October 3rd, I put a tweet out thread saying that back then, when everyone was bearish, I said, I believe conditions now favor a melt up. It wasn't a call. It was me basically looking at quantitative metrics that all got so extreme, sentiment that was so extreme that it's like that's the setup for a big move. We can quibble about whether it was a melt up in definition, which nobody seems to properly have a definition for to begin with, but it was a 17% move in the S&P in a matter of 2 months and fairly sizable. And then December 3rd, I then put another tweet thread saying, now I believe the conditions favor an imminent stock market crash. You didn't have a crash, but you had the fifth worst December in history. And it wasn't based on some gut feel, right? It was based on metrics, historical data. Now, entering this year, somebody said to me, what about that crash? I said, well, it's not as clear to me the way that this year is shaping up. And I say that because if you look at what's happened out of the gate, emerging markets have been outperforming significantly. Small caps are showing some strength. Lumber looks like it may have bottomed. Utilities have been so strong for so long as a defensive sector that it's probably due for some kind of weakness, right? So you're at a point here where there's so much negativity from an intermarket perspective, and the length of time of the negativity has lasted so long that you probably are going to have some kind of relief rally. That's why, I put a poll out saying, would you consider it exquisite or atrocious, right? If I thought a melt up now was coming following the imminent crash argument, which obviously didn't play out, but again, fifth worst December. Now, it wouldn't surprise me at all if you have some kind of run higher. And I say that also keeping in the back of my mind seasonality. So you're still in the best 6 months, November to April. You're in the third year of the presidential cycle, which is historically the best year, right, of the 4-year presidential cycle. So that's one part of it. I think at some point, though, you're going to have a credit event. Okay, so you could have a move higher and then maybe a real risk-off move lower. And the reason that I say I think we're going to have a credit event is the damage is done, and there's a delay in terms of interest rate movement and how it impacts the economy. One of the things that's been really remarkable about last year in the carnage of the bond market is that it really wasn't the classic carnage you would have thought. In other words, it was a duration collapse. It was a duration crash, right? Whereas credit spreads stayed relatively tight, right? In other words, the market did not reassess default risk premiums among highly leveraged borrowers. Because there's a delay and because we just went through the fastest rate hike cycle in history and because housing still, no matter what lumber does, is going to have some kind of real pain going forward, independent of short-term wiggles and optimism. That, to me, is the setup for what is typically what you see at major capitulation moments, which is VIX spikes, credit spreads blowing out, real risk off where treasuries go back to that sort of flight to safety status, which was what was missing all year, was what hurt my funds so dramatically. I don't think it's necessarily here and now, but I think it's probably looming at some point this year, this kind of real risk of a wave lower that looks more like a classic type of correction or crash.
Gotcha. So you are, with all of these things that I see you tweeting about and talking about, you are very much about assessing conditions. Like you're very much into timing and about assessing conditions at any one given moment.
And let's kind of explore that thing because I think this is important.
Yeah.
What matters when you're driving is not knowing the exact mile marker that you crash your car. What matters when you're driving is it raining or is it sunny? Now, just because it's raining doesn't mean you'll crash. Just because it's sunny doesn't mean you won't. But they set the conditions that set the probabilities, right? So gotcha. I don't believe in making calls. And it's funny because it's like even with those threads where I explicitly on Twitter said, I don't believe in making calls, people said, what happened to your melt-up call? What about your crash call? So these are not calls, right? I'm trying to say this is what you typically see as the surrounding set of conditions under which an outcome likely takes place, right? It's a really, really important nuance because it means that you have to basically look at history to see if multiple roll of the die get you to the probabilistic expected value and outcome. Okay. So conditions are always changing, right? I mean, every single second conditions you can argue are changing. Probabilities are always changing. It's not static when it comes to markets. It's never all else being equal because nothing's ever fully equal. There's always new information, always new movement, always new reassessments. So you've got to be kind of aware of that. Just like when you're driving, every single, foot further in the mile that you're driving, could be more rain or less rain, right? But you still have to kind of adjust to that. Now, you said timing. So this is also, I think, really important. There's a difference, I would argue, between asset class rotation and market timing. Okay, and why am I saying that? All the studies around market timing correctly show that market timing doesn't work, meaning you're timing the asset class or cash. Why does that not work over time from a backtesting strategy development perspective, market timing? Because cash does not allow you to be wrong and make money, right? So if you get a signal to play defense and your expression is to get out of the stock market and be in cash, you don't have a chance of momentum and compounding. Same reason for why shorting doesn't work. If you're wrong in your expression of playing defense and making an outright directional bet on the downside, you're going to get destroyed because markets tend to go up more often than not. So you're going to be wrong actually in your defensive signal quite a bit. However, if you view it from the lens of rather than going in reverse when it's raining or outright stopping when it's raining, slowing down, then you can maybe avoid the accident. Now, the two primary ways of quote unquote slowing down are defensive sectors, if you're a long only equity manager, utilities, consumer staples, healthcare. But then the real way to play it is long duration treasuries, right? That flight to safety trade, which again is what failed last year. Now, I built my funds around that. ATAX, RORO, JOJO, all of them use different signals, right? They're all using different indicators of the weather, but they all have the same problem. They all slow down with the same breaks, which is long duration treasuries for a reason, because that's what history would suggest. So I think that will be ultimately, and that even relates to the credit event argument, that is going to be what's really critical this year. Did we truly go, as I believe, through an anomaly where the flight to safety broke And if we did, now you've got money that you can make being risk off in treasuries in another highly volatile sequence when the conditions reassert themselves, saying you might want to slow down.
Okay. And with what I was going to say before, without, I never ask anybody to give away their secret sauce, but I'm still inclined to just ask, how do you make these assessments? What is it? What changes to suggest to you, oh, the conditions are right for a melt up or for a crash or whatever?
Okay, so it's not even secret sauce. I mean, the ingredients are all public, right? I mean, it relates to these different research, even the research studies, even these different funds, Roto and Jojo. What people don't understand on Twitter is that they're rules based and they have indices, which are available and run by VanEck. They have a business line market vector. So it's a rules-based index, and the ETFs are attempting to try to track those indices based on certain indicators, right? And that methodology is public. Anybody can actually download the PDF guide of how those indices are created, which means they could replicate conceivably what was horrible performance for those funds last year because of the failure of treasuries. So look, the reality is there are very few real predictors when it comes to markets. I know this because I've tested everything you could possibly imagine. And I think unless you've really done a lot of back testing, you're not going to get a full appreciation of just how cynical one should be when it comes to anything anybody says as to why stocks would do what they do. The 5 different research studies that I put out there that won these different awards, which doesn't mean anything except that they were validated by peers in the industry, shows that certain indicators tend to get ahead of highly volatile regime shifts in equities, which is what risk off is. It's not no risk. Risk off is ultimately about volatility dynamics changing. Utilities against the market, lumber relative to gold, long duration treasuries against intermediate, where you are on the relative to the moving average, and then VIX levels at extremes. Those are your main indicators. All of those basically relate to the same concept, which is that what ultimately drives the likelihood and the conditions is the demand for money changing. Okay, so what do I mean by that? Utilities are the most bond-like sector of the stock market. Highly levered, the bulk of their earnings variability is driven by interest expense. So they benefit when rates are falling. Why would rates be falling? Demand for money is falling, right? Lumber is about housing, which is about mortgage rates. Same idea. Demand for money is falling or rising. The moving average, even, I'd argue, usually when you're below a 200-day moving average, you're already in a recession, historically, right? Demand for money is falling. Long duration treasuries against intermediate, a form of yield curve flattening further out on the curve, demand for money changing. So the point is, typically when you have a really sunny environment or really, really rainy environment, all the signals will line up in different ways, even though one at one point may disagree with another, but when they all kind of give you the same message, that's your tell, right? So, because they all tell you about volatility, right? So I'm kind of using this methodology of, yes, my funds are based on specific single indicators, but if you see multiple single indicators that tend to get ahead of major changes in volatility, confirming the same message, that tends to maybe tell you should think a little bit differently about markets.
Let's talk about one of those relationships that I've seen you post about a number of times. Lumber to gold. I can honestly say that I never really heard anyone talk very much about this, but to you, it's a pretty important relationship.
Yeah, only because I live in a house. Right? I mean, that's kind of the thing. It's like, so I'm a big fan of behavioral finance. There's you're probably familiar with the invisible gorilla study, right? So there's a study, I forget the gentleman's name, but it's a great book. It's called The Invisible Gorilla, and it's a study. You can actually go on YouTube and see the video. And I'm going to butcher the exact way that the study was done, but basically a bunch of psychologists, whatever, they wanted to try to test attention spans to some extent and to see if people could focus on things, right, the proper way. So they had a bunch of participants sit down and watch a video. And they were told, these participants, you got to count how many times a basketball is being passed around these different players, these athletes in the gym. Count how many times the ball is going back and forth, back and forth, back and forth. So participants come in, they sit down, they watch the video, and they're counting the balls being passed. And then somewhere around the middle of the video, there's a big gorilla suit, a person in a gorilla suit just walking across as these players are throwing the ball to each other. Right? It's literally just, it's clear as day when you see it. You see a gorilla, right? When they asked the participants how many balls were passed, how many times was the ball passed, they gave the number. Then they said, did you notice anything unusual about the video? They said, no. What do you mean? So half the participants did not see the gorilla. that was directly in front of them because they were so focused on the counting of the basketballs being passed.
Right.
So I'm relating that to lumber in the sense that it's so obvious. It's like right in front of us, but we don't even think about it. Lumber is the key commodity that goes into framing. Lumber is incredibly correlated to housing starts. Housing is the number one asset. Homes are the number one asset for most consumers. So to the extent that housing tells you something, it tells you something about the economy, and to the extent that lumber tells you about housing, it makes sense that lumber should be paid attention. People should pay attention to lumber more because of that follow through to construction, credit creation, wealth, all that stuff.
Got it.
The idea of comparing it against gold is that gold tends to act as a safe haven as a commodity when you have these kind of high risk periods in equities. So that's pretty well documented, at least in a short period of time. So you basically compare a very cyclical commodity, which is a tell on housing, to a non-cyclical commodity, gold, which tends to be a tell, a little bit of risk off. It actually tells you a lot about sentiment changes and, again, volatile regimes shifting.
I see. So when you see gold rising versus lumber, this is risk off-ish. When you see lumber rising versus gold, it's kind of maybe economically good.
Yeah, or at least there's more liquidity, expected to come in. Because again, if it's about demand for money, it's about liquidity.
Mm-hmm. Okay. It's funny because I ask you these things and the answers are all so simple. And
It's very simple.
They are the guy in the gorilla suit. And I'm like, oh, yeah, okay. Yeah. And I think just the fact that, it's sort of like not sexy, but it's got teeth, and you're the guy who understands that. I just want to underscore that for our listener because it has a lot of value. And that tends to be the way things are in investing, isn't it? It's like, it's not about being a physicist and knowing how to, do complex calculations in your head or anything. It's just like honoring these simple relationships and simple compounding over time and all these sorts of things.
It's also, I think, about understanding and respecting that it's more than just signal, right? So all three of my funds, ATAX, Roro, Jojo, they all use different signals. I have every incentive for them to work, but they're rules-based. I'm not applying a discretionary way of thinking about how to rotate, right? It's based on these relationships, lumber, gold, utilities, all this stuff. Okay. The signals pretty much have been right all throughout 2022, meaning the bulk of 2022, lumber was weak, risk off, high volatility for equities. The bulk of 2022, utilities were strong, risk off, high volatility for equities. Mm-hmm. Usually, the way to play high volatility in equities is treasuries, long duration. Again, long duration treasuries ended up being more volatile than equities. Now, this is also, I think, important. That's why I always go back to every strategy is a function of signal, lumber to gold, moving average, whatever it is, opportunity set, okay, how you express the signal, and then look back period, meaning what time frame you're evaluating the signal over. Mm-hmm. The problem last year was the opportunity set, right? In my world, it was long durations as treasuries as the expression of risk off, where in the first time in history, long duration treasuries lost more money than equities and had a very unusual path against stock market volatility. That doesn't mean the signals were wrong because I had drawdowns in my funds, right? The drawdowns in my funds were explained by the behavior of treasuries interacting against the signal. And this is also, I think, really nuanced because I think on FinTwit in particular, a lot of people focus on a particular indicator, but you have to really ultimately focus also on what you're expressing the indicator on, which means you need to have a cycle also favoring your opportunity set for the indicator to ultimately generate returns. A good example of that. Forget about lumber to gold, forget about utilities. Let's just use a stupid momentum signal, right, which everyone uses on everything. If you were to do a momentum trading strategy on the S&P 500 for the last 10, 12 years, you did pretty well. If you do the exact same indicator on emerging markets, death by 1,000 cuts. Because there's been no momentum, right? Every time you try and play, it doesn't persist. But the indicator is the same, right? So my point is, you need to also think, I think most investors underappreciate how important having a secular tailwind from a cycle perspective is to what you're expressing a signal on, right? Mm-hmm. It's more than just lumber to gold or utilities. It's, is there some kind of tailwind that favors the indicators not only being right, but actually being right in terms of volatility, but also profiting from the volatility changes.
Gotcha. Yeah. Nothing is simple. Nothing is static. It's always changing. It's a great point. And, we talked to Jeffrey Zuckerberg, the guy who wrote the book about Renaissance. And I was amazed that he got people to talk about Renaissance. And he says, you know, they're constantly looking for new signals. It's endless. And it's an army of people constantly looking for new signals. So that, you know, makes a lot of sense. It's a point well worth making in front of this audience, because I promise you, like, so many people that I talk to in our business, you know, customers and clients and things, they just tend to want to get that sort of perfect indicator and then just, you know, keep pressing that button, you know. So, you know, thank you for making that point.
No, and by the way, so this, you're hitting on something actually which I think is really really interesting and important for the audience, which is that you always hear this line that you need to have the mindset of adaptability. So, okay, so this is an important point. So I will always, you know, I do these Twitter spaces, these conversations, and I always get people saying that, well, you know, you have to have the mindset of being able to adapt to the current environment, that if something is not working, you switch to what's working, and this and that. I have a real problem with that. I have a real problem with that because the assumption there, the implicit assumption, is that you can create a strategy which is working at all times, independent of the environment that you're in. That's nonsense. You can't always adapt to the here and now because it assumes the here and now persists. Right? It's like it's right. So it's an impossibility to create a perfect strategy.
Right.
So I think rather than sort of focusing on the idea of what do you do to adapt to the current environment, what people should focus on is, can you stick through your approach in an environment that is not favoring you, right? Which is a very different way of thinking about things.
Yep, absolutely. Like, every strategy underperforms for some period of time, even if it's the best thing in the world. And the idea that you're going to swap strategies in and out at the right moment, you know, it's just ridiculous.
No, it's nonsense. It's chasing optimization. I mean, Madoff pulled that off.
Yep. There you go. That's how you get perfect returns. Just commit fraud.
Yeah. I mean, listen, SBS knows that himself, right? I mean, until that one day, all right? I mean, that's so. Yep. So I think that's important. So look, and the thing is, like, if you have the mindset of cycles and sticking through a cycle, that brings with it kind of two interesting dynamics. One is, it means that hope is a strategy. Hope is a strategy, right? Because it's like you have to hope the cycle comes your way in order to stick to it, right? That's number one. But also, it just makes you appreciate that if you're going through a cycle where your approach is not working, the dislocation that you've tested, that you believe in, is probably getting bigger, which means the forward returns are going to naturally be higher. It's like, you know, most people, they worry about a drawdown after a drawdown's already taken place, whereas the best way to avoid a drawdown's after one's already taken place. Right? The returns are naturally higher after a drawdown than before, but they get nervous after the drawdown. That's going to go further down.
Right. Yeah. That's right. It's the classic example of this, of course, is like everybody abandons value at the top of the technology cycle, right? And then they magically rediscover it at the bottom, right? And we've seen some of that too this time around.
Right.
So, Michael, I just want to make your position clear. Right now, you're looking for this credit event, maybe, because the conditions favor that, you think. At the same time, you're looking for a melt up. Can you give us magnitude on that, or no?
I have no idea. So, okay, a couple of things. And no one does, right? It's like, so again, it's about sequence. I suspect you probably have, because the relief rally in lumber is there and long rates are falling, and at least at the margin, that's perceived to be positive because it means inflation probably overshoots too on the downside. So that, I think, means that you have, in the short term, a bullish setup. And then again, at some point, some kind of credit event kind of kicks in. Now, the magnitude question is always tricky, right? Because you never quite know. I had a lot of people throughout December say to me, how would you define a crash? And I purposely never really quite fully answered it, at least then, although I've done it publicly many times before. Like, I don't view a melt up in terms of percentages. I view it in terms of time. I don't view a crash in terms of percentages. I view it in terms of time. So historically, you look at major crashes, you go back in time 9-10 months. Historically, with melt ups, you end up having, in a very compressed time, an undoing of the last several months of weakness. So magnitude is ultimately a function of perception, right? Somebody might think 17% is a melt up in a year, but in reality, it's probably not. 17% in 2 months is probably more of a melt up because of the time component of it.
Interesting. So now, within a very short period of time, I've had not one, but two professional traders on the show who have talked about time. We talked to dozens and dozens of people. I've been doing this a few years. I must have interviewed, a few hundred people, lots of traders. Very few of them talk about time as you do. You're like the second, maybe third, maybe I'm forgetting one, let's lean into that a little bit. When you say you think of a melt up in terms of time, you just mean like the time frame over which you expect it to occur. It's like a weeks long thing maybe, and not a months or years long thing, for example.
Right, because it's like if you were to annualize a fairly sizable outsized move in a short time frame on an annualized basis, that's a huge number, right? So you can't view magnitude by itself without factoring how long it takes for the move to occur, right? I think it's kind of the point. I also think, by the way, it is just more of a side note. It's amazing to me how people people only hear what they want to hear. Whatever they choose to hear is a distorted version of reality. So a lot of people think melt up means S&P going to 6,000. It's like, no. I mean, that term never meant that. It was always used as a way of, you can argue hyperbolically, arguing that stocks could have a stampede higher, but it's more just a descriptor of the conditions, the environment. It's not necessarily sort of a question of, it means you're going to break to new all-time highs at all. Only some people popularize that. They change the definition. That seems to be the case nowadays. Everyone's changing definitions on things left and right. But that's not the real definition of what a melt-up is. Or same thing with a crash. It's like, all right, so if junk debt goes down 5% in a day, equity investors would say that's not a crash. Of course that's a crash. It's a crash in junk debt, right? Adjusted for time and the way that junk debt moves, right? So that's what I'm saying. That I think I get it. Everyone always wants to get a percentage of magnitude, but it's more than that, is my point.
Yeah, no, that's a great point. I'm glad you said that, because that was my next thought. So what you're saying then is like, I mean, I feel like people have become inured. They've become used to like, drastic moves. We just went through this period, which I was kind of calling a mega bubble, and people thought it was normal for some crazy stock that probably shouldn't even exist as a company to be going up 20%, 30% in a single day. People get used to that, and they don't understand how utterly unusual it is. And now here you're coming and saying, a little 5% move in junk bonds in one day is a huge deal. That's a crash. And I feel like as we speak, we're still getting like meme stock action. I feel like these spirits, this idea still hasn't been crushed out of people. It's like they haven't unlearned it. It's like if you think there was a bubble, it's still popping. It's still here.
Yeah, no. So this is actually, I had ranted on that all throughout 2021. I would say multiple times on Twitter, you can look it up. I said the level of uneducated speculation is astounding. Uneducated speculation, right? That's not to say that this is a domain only for educated people, right? But at least you got to know what the hell risk is, right? And know how numbers work and know history, right? So yeah. I'm with you. I still see it even today. I still see the memes. I still see, it's like, all right, well, I'm beaten, but the bell hasn't rung yet, right? Is that kind of mentality by the same uneducated speculators who didn't view the past year and a half, 2 years as a lesson. They viewed it as a bump in the road. Like that mentality is, I think, and that's also why I believe the bear market's not over. And I can go back to that line. It's like, I've used that line also many times before. Bear markets make fools of bulls and bears. Bear markets make fools of bulls and bears. And I'm using that terminology purposely because in bear markets, stocks are volatile. In bear markets, stocks can have significant, meaningful bear market rallies or melt-ups, whatever term you want to use. They can have significant sudden collapses. That's what volatility is.
Yeah. We had another guest on, a guy named Christopher Cole, who's kind of a volatility-focused trader. And, he talked about volatility as like truth. Yeah. He's very profound about it. Volatility is like, it finds you out. It finds the bears and does a rally, to take them out. And then it finds the bulls who are getting back in and cuts them off at the knees again. This is a time of the truth. I feel like the truth is coming out. The truth comes out in bear markets. We find out who's been swimming naked, right?
Well, yeah, and I'd argue it also shakes conviction and confidence, right? So I don't view volatility as fear. I view it as doubt, right? So all right. So if you were to overlay the VIX index, the volatility index against credit spreads, differential between junk debt and AAA, you see pretty much a 1-for-1 relationship. So when you have volatility in equities run higher, you have a VIX spike, junk debt becomes junkier. The differential between poor quality debt and high quality debt widens, even though VIX is about equities and credit spreads are about bonds. Okay, why is that? Well, if volatility is about doubt in equities, it stands to reason that which has a higher claim on collateral on the balance sheet okay, which is liabilities, the incomes, the debt side, right?
Right.
That there should be doubt about the possibility that a company stays in existence, which is default risk.
Right.
That's the
So,
relationship, which is what risk off is basically.
Sure. Yeah. I mean, if equity is the cushion that the debt investor looks at, I mean, the first guy above that is the junk holder, right? So he's going to have a problem quicker than anybody after the equity guy gets wiped out.
Right.
Yeah. Yeah. Good stuff. So I feel like I could just hit on so many topics with you, but we've actually been talking a little while. So I'm going to throw my final question at you, and you can go anywhere you want with this. It is the identical question for every guest, no matter what the topic. And the question is simply, if you could please leave our listeners with one thought today, what might that be?
Read. No, really, I'm sincere when I say that. It's like people, are too busy drawing lines on a chart, which anybody can do, including a toddler. It's like, you've got to. I tend to be of the just mindset in every domain that if you want to get good at something, you've got to put the time in. You've got to put the concentration in. You got to read the books that go into it. You got to read the textbooks and the non-textbooks. You don't read tweets to learn about markets. And it's like I had somebody a direct message at Lead Lagerport said to me, "What's your advice for somebody wanting to learn more about markets? Which account should I follow?" I said, "Get off Twitter." Which is counter to my own best interest, right? Like I use Twitter for marketing, obviously. I mean, it's a persona with my account and the way that, to your point, I've branded it, but I'm using it as a way of, hopefully some degree of interest by an audience that may be willing buyers when the time comes for the funds or anything else that I do in my life and my career. But you're not going to learn something unless you spend the 10,000 hours, the old Malcolm Gladwell arguments, right? Of just the grind, right? And so I think the biggest thing is people just need to either go on your Kindle and actually read these old books and go back in history and see how behavior doesn't change in the way that markets are described and the way that people felt about prices, whether it's the 20s, 30s, 40s into 2023, right? I think that's the biggest thing. I feel like we I don't know if it's a generational thing, and maybe this is me, as I get older, the old man and yelling at the cloud kind of thing. But yeah. I worry about every generation's ability to know what it takes to be at something long enough. Now, look, a cynical person would say, well, your funds didn't do well at all last year. My mutual fund I launched in 2012, just before QE3. It's risk on, risk off, just before one of the smoothest risk on periods in history, where it was all about the S&P. It rotates around emerging markets and small caps. And I keep the fund alive, open, and it had a hell of a year in 2020. It was up 72%. I say all that because only with experience and knowledge and study do you know that cycles are a thing. That's what keeps you energetic, even if in the short term, nothing seemingly is going your way.
Oh, man, that's a great answer. Summed up in one word: read. Yes, get some depth. Get off Twitter. I love that. Thank you. And I love talking with you. Thanks for coming back and talking with us. And you can better believe that, sometime in the next 6 or 12 months, you're going to get another call from us. So
few understand this.
There we go. Perfect. All right. Thanks a lot, Michael.
I appreciate it.
Hey, Dan Ferris here. As you just heard on the podcast, 1 year ago, my colleague Greg predicted a market crash. He was spot on. He had the nerve to say, 2022 will see the worst crash since 2008. Sure enough, you could have doubled your money 6 times with Greg's recommendations after he nailed the crash of 2022. Well, today Greg is back with his newest prediction for 2023. And keep in mind, he even predicted the 2020 crash 3 months before it began. And you could have doubled your money 11 different times on his picks leading up to that. He's been doing all this using a strategy that dates back to the Civil War. And once again, he's agreed to show you how to potentially double your money in 2023 over and over again without touching a single stock along the way, including the exact date he predicts a huge market move. To learn more, go to dan2023.com. That's my first name, dan2023.com, where we're posting the full details of where stocks are really going next from the guy who nailed the 2022 crash. And by the way, we also have a special surprise for you on that site, which has drawn the interest of 750,000 people already. But you can see it free of charge at dan2023.com, including the name of Greg's number one stock for 2023, which you could have already doubled your money 5 different times using his strategy. You'll get it free of charge from dan2023.com. So check it out right now. Hey, that was something. That was the second time, the first time being recently with our interview with Greg Diamond, that we had a trader talking about time, right? He said time is the most important thing. And it's an abstract topic, and you can listen to our interview with Greg Diamond and obviously this interview to know exactly in what way time is important. With Michael, he talked about the path, right? So the path from here to a credit event might include a melt up in stocks, for example. So path is really important, and that plays out through time, doesn't it? And then, he just talked about time frame. We mentioned like the time frame for a melt up or a market crash. It's not years, it's like probably weeks. And so time becomes very important there as well. And I like hearing about this. It's one of the 10 heresies of finance in Benoit Mandelbrot's excellent book called The Misbehavior of Markets. And he has these 10 heresies of finance. And one of them is something like, I forget exactly how he put it, but I think basically timing matters. Timing is important. And time, he talks about time throughout the book as being important. And lo and behold, we finally got a couple of traders right in a row talking about it. And other than that, I just think Michael's an interesting guy. His Twitter feed is at LeadLag Report, LeadLag Report. On Twitter there. I encourage you to follow him just for the sheer fun of it. He's like insightful, but also like very entertaining in his insights. Really a fun conversation. I hope you enjoyed it as much as I did. We say that a lot, don't we? Yeah, so that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.